Okay, hello ladies and gentlemen, and welcome to this webinar brought to you by City Index. This is part of our regular Wednesday series. Every other Wednesday we bring to you an educational webinar regarding some aspect of trading. And today we're going to be talking about trading with the trend as well as counter trend and range trading. And with this, I do apologize. 2 weeks ago when the trading with the trend webinar was scheduled to be held, we had some technical difficulties and therefore we weren't able to do that, but here we're combining both trading with the trend and counter trend and range trading. So I'm probably going to be talking pretty fast here. Now, just as a point of note here, in terms of what just recently happened, just today actually, a few minutes ago, we had the FOMC minutes come out from the US Fed, and we saw a resulting drop in the US dollar and a rise in gold, as well as a surge in the US indices. So that was pretty interesting what we just saw. Now, also in terms of crude oil, if you take a look at our website, you could see that I did a piece today with regard to crude oil. This morning it had surged quite a bit because of yesterday there was a report that came out from the American Petroleum Institute talking about a rather large decline in oil inventories. And then today another report came out also showing a decline in U.S. Oil inventories, but apparently not enough. So we saw a big whipsaw in crude oil in terms of the price. So this morning it went all the way up, and then towards the afternoon it went all the way down, and then it came back up again. So lots of whipsaw there. Very difficult to trade in those types of situations, especially when data is coming out. Therefore, for example, with the FOMC meeting, that just happened, I prefer to stay on the sidelines during these types of events and data that are scheduled, that are coming out, and that can affect the markets in very, very significant ways. And if you are a technical trader, which I am, if you like to trade with the trend, or even if you're a counter trend trader, these some strategies tend to go out the window when big data comes out. So just be wary of that. So again, yeah, we saw a big whipsaw in crude oil, and now we saw a resurgence in the U.S. indices and gold, and a pretty sizable drop in the U.S. dollar. Let's take a look here. Yeah, this is a pound dollar chart here. We see that the U.S. dollar has dropped in the last hour because of the FOMC meeting. Okay. So let's move forward real quick. Now, I was going to be talking about today. I was going to be talking about counter trend and range trading, and I will be talking about that briefly. But what I really want to show through this webinar, or the argument I'd like to give, is why counter trend trading, which is basically mean reversion trading, and I'll explain that in a minute. But why counter trend trading can often be counterproductive, and that's why I prefer to trade with the trend. I want to show why it's much easier and often more effective to trade with the prevailing trend than against it. Okay, and and I'll show in a minute why the only time I really look at trading against the trend would be within ranges, within trading ranges where I trade long towards the bottom and short towards the top. Other than that, though, also, after pullbacks, and I'll explain that in a minute, those are really the only times I'm going to be looking to counter trend trade a market. Okay, because essentially looking for tops and bottoms, searching for tops and bottoms, and trying to pick tops and bottoms, which is essentially what you're trying to do when you're counter trend trading, can be very risky and uncertain. To try and pinpoint these. So I'll get to that in a minute. Just before we get started, real quick, a quick disclaimer: financial trading carries a high level of risk to your capital, with the possibility of losing more than your initial investment, and may not be suitable for all investors. Ensure that you fully understand the risks involved and seek investment advice if necessary. Okay, we're going to move forward in just a second. Okay, and my name, if I didn't mention it, my name is James Chen. I'm the Chief Technical Strategist at City Index Group, which means that I trade, I analyze, and I educate, much like what I'm doing right now. So we'll skip over that real quick. And let's take a look very quickly at the educational webinars. These are the past webinars in gray here, grayed out. And today's, of course, trading with the trend, counter trend, and range trading. And of course, as I mentioned, last week was supposed to be trading with the trend, but now we're combining it here into one. And basically, again, as I mentioned, the counter trend trading is really something that I like to show that I don't do very often, and I only do in very specific cases, and I'll show you that. But today, what I'm going to be showing you is, okay, I see that someone is not receiving audio. If you could hear me, please type in yes. Okay, great. Okay, great. Looks like you guys can hear me. For some reason, sometimes some people, come in and out in terms of hearing the audio. Okay, so what I wanted to show you again is a broad overview of how, I trade, how many traders trade with the trend and against the trend, and the tools that we use. So I'm going to show you all that. 2 weeks from now, we're going to be talking about breakout trading, which is a specific type of trading where you're looking for basically volatility breakouts of support and resistance. And then from there, we're going to be talking about trend line. We're going to get really granular in terms of trend lines and trend channels, which I'm going to introduce a little bit today. We're then going to be talking about trading divergences, which are divergences between price and momentum. And then we're going to be talking about trading with moving averages, which I'm, again, going to be introducing today. And then we're going to be talking about scaling in and out of trades. And as I mentioned, this is an ongoing series, so we're going to be moving, forward with a lot of different topics from here. But this is for the next, for the foreseeable future, next couple of weeks. Next couple of months. Okay, so let's get started with trading with the trend and counter trend and range trading. So as far as I'm concerned, really there are three primary methods to trade any time frame. And basically these three are trading with the trend, which is trading with the prevailing momentum of the market. Okay, and this could be on any time frame. So a lot of people ask me whenever I do these webinars, what exactly are you talking about? Are you talking about trading with the long-term trend, trading with the short-term trend, trading with the very short-term trend, or what? And my answer to that is yes. I'm talking about all of them. In terms of trading with the trend, it really depends on what type of a trader you are. If you are a long-term position trader, you should probably be looking at the daily chart, sometimes even the weekly chart, although I don't often do that. The daily chart I look at, sometimes the 4-hour chart. If you are more of a short-term trader or an intraday trader, then maybe you're looking at the 5-minute chart or the 15-minute chart or what have you. So basically all of these phenomena, these technical phenomena, this price phenomena that occur, and these opportunities that present themselves occur on all the different time frames. Yes, there are differences between the time frames, of course, and what I often say is that on the shorter term time frames, there's lots of noise. There happens to be a lot of noise that I prefer to avoid, and therefore I'm looking towards the longer term time frames. Okay, but getting back to this, the three primary methods are with the trend, against the trend, which is counter trend. Okay, this could also be called mean reversion, reversion to the mean or reversion to the average. Some people say, an object in motion will remain in motion. That's the trend, okay? And other people will say, that everything has to come back to the mean. Okay, so what goes up must come down. Okay, these are all physics analogies, but they really describe these pretty well. So again, with the trend is what is inertia. An object in motion tends to stay in motion. Against the trend is what goes up must come down, and basically that's a way to describe both of these, and they're both valid ways to trade, but I much prefer trading with the trend, and I'll show you why in a minute. Now, a third way to trade any time frame is within a bounded range, and we could see this, for example, on the crude oil. So I'm going to show you U.S. crude oil, the WTI, or West Texas Intermediate crude oil, we could see that we're in a very bounded range right now. And you could look to that range to possibly trade between the lines, if you will. So these are three primary methods to trade. I mean, when you really look at it, any strategy that you're using is going to be, any technical strategy that you're using is going to be one of these, is going to be employing one of these primary methods. You're trading with the trend, you're trading against the trend, or you're trading within a bounded range. Now, some people say trading within a range is akin to counter trend trading, and that could be true. But basically, there are these three primary methods. Okay, and I'm going to talk about all of these. Now, the primary tools that we use to trade any of these methods, whether you are a trend trader or a counter trend trader, or you're trading or a range trader, okay, is these are the primary tools that we use. Number one is, of course, is always price action. Price action. Price. Everything follows price. So you look at any indicator on your chart. You look at any trend lines or moving averages or Fibonacci levels or oscillators or any tool that you have on your chart. Basically, they all follow price, and most of these indicators are mathematical derivatives of price, which means that they move only because price moves, and therefore price action is first and foremost. Second of all, very important, are support and resistance. Okay, support and resistance are basically levels, horizontal levels in the market where price tends to turn. Okay, so where we find supply and demand, and I'm going to talk about that in a second. And then we use trend lines, and I'm going to show you that in a minute as well. We use moving averages, we use chart and candlestick patterns, we use oscillators like MACD, like stochastics, like RSI. Although I'm not going to be concentrating completely on these. These are confirming indicators. They help. Okay, they help. Now we also have Fibonacci levels. So these are the main tools that I use, and I'm not. I've done webinars in the past where I show, and you could see all these webinars, and it's just this question from JM here, where can we get previous webinars? You could find them all recorded on our website at cityindex.co.uk, and today's webinar is no exception. It's going to go up tomorrow morning. It will be, it's currently being recorded and will be put up there tomorrow morning, so you could take a look there. Let me just make sure it's being recorded. Yes, it is. Okay. So you'll be able to see all of that. I talk about each of these different aspects or these different tools whenever you're trading. I talk about these in my previous webinars, and I'm going to go over them real quick today. But basically, these are the primary tools that I use when I'm trading from a technical perspective. Now, many people may ask, like for example, with the FOMC, the Fed announcement that came out today, am I going to be trading that from a technical perspective? And there are traders that do that. There are technical traders that trade on events, using technicals as well. But from my perspective, I tend to stay on the sidelines. As I mentioned earlier in this webinar, I tend to stay on the sidelines when when I know that events are coming out. Some events you don't know are coming out. Some announcements you don't know are coming out. What's happening in Greece? We don't know what's going to happen. At this point, we're not quite sure what's going to happen. But with scheduled events like the FOMC meeting, like the non-farm payrolls, like the crude oil inventories that came out yesterday and today, we know these are coming out, and therefore, are we going to be initiating positions right before or during? Probably not. At least I'm not going to be, because for me, it's too risky. It's too risky and it's too uncertain, and therefore, I'm looking to stay out of those types of trades. Now, that being said, if I'm in a trade, if I happen to be in a longer-term trade during these events and announcements, then what I'm going to be doing is, generally speaking, I'm going to be watching and I'm going to be looking where my risk is, and then, I'll be ready to react. Usually I have stop losses on all of my trades, so I have that at the ready, but I'm also going to be watching very closely any of my positions to see what type of risk I have, okay? Okay, so these are the tools that I use. I'm going to go over them real quick. And then we are going to take a look at some charts And if you have any questions, please feel free to type them in. This is just going to be a very broad overview of the different types of trading and how I like to trade. But essentially, again, ask any questions that you have. And I just wanted to go back to this trading, this counter trend trading. Now, I think it makes sense to most people when you talk about trading with the trend is you're trading in the momentum of the market. I mean, all you have to look at is something like this. It's a chart like this. This is the pound dollar. This is a current chart of the pound dollar, an hourly chart of the pound dollar, and you look at the appreciation in the pound against the dollar. And of course, it continued today because the, not all because, but primarily because of the dollar weakening after the FOMC meeting. But we take a look at something like this. There are defined trends. There are definitely trends within the market that are defined and that are actionable. And we take these and we use them. Now, if there is a defined trend and you're looking to counter-trend trade this, my question is, why would you be? Now, the question is, perhaps you would be looking to counter-trend trade this because you're looking for an exhaustion. Like, for example, now you see that this move to the upside, maybe it went too fast, too far, so you're looking to short this. You're looking to short pound dollar. Well, I would never be looking to short a runaway train. I'm never going to be looking to stand in front of a runaway train, okay? Because yeah, it could be exhausted. It could come back down, but in terms of the timing, your timing has to be absolutely perfect in order to be able to catch this move without losing your shirt in the process. Okay, so that's why I'm saying yes, there is price exhaustion. There are moves that exhaust themselves, and there are always pullbacks that occur. But timing those is the tricky part, is the difficult part, and for me is the risky part. So that's why. Why would I be looking to short it right now? With my luck, it'll probably go down now, and then people will say, look at what he said, and it went in completely the different direction, the opposite direction, and but essentially, trying to time this move back to the downside is very difficult, very risky. Okay, so enough of that, but that's what I wanted to put out there. So that's why in terms of the counter trend trading, the only type of counter trend trading I will do, and you could call this counter trend trading or you can not call it counter trend trading, but the only type of counter trend trading I will do is something like this, okay, where there is a trend here, okay, there is a short-term trend to the downside, and I'm looking to trade to the upside on a recovery after that pullback, after this pullback recovers. So I'm looking to go long here, okay? Why am I looking to go long here? Well, what is this? Is this counter trend trading or is this trend trading? It could be very confusing. Essentially, this for me is trend trading. But some of you may say, okay, there's a downtrend here. Why would you be looking to go long if you're a trend trader? Well, I'm looking at the overall trend, and this happens to be an hourly chart. I'm looking at the overall trend. The overall trend is to the upside, and there are many ways to see why this is to the upside, and I'm going to get to this in a moment, but essentially, if you're trading long here, you're trading after a pullback, and I'm going to get to this in a moment with my trend pullback breakout approach. But basically, you're trading with the trend here. Yes, there was a downtrend, but this downtrend is a pullback within the larger uptrend, and therefore I'm looking to go long right after this pullback exhausts itself. Now, we are still in an uptrend. Am I looking to go short up here, all the way up here? No, I'm not. Okay, even if it goes down, fine, that was luck. Okay, so if it went down and then if I happen to be short there, if I happen to catch the very top of this and I'm short there, then fine, I made some money. But that for me is purely luck. It's not really prudent trading. Okay, I'm looking for a continuation of the trend. Okay, now would I go long here? So you asked me, am I, if I'm not going to go short here, would I go long here? And the answer here is no. Also no. Why? Because I'm not looking to buy the highs. Okay, I'm not. Even though this is an uptrend, I'm looking for a long position. I'm not looking for it at the extremes, because that for me is folly. Is pretty much folly here. in terms of going long at the highs or going short at the lows, okay? In a downtrend, let's say you see a low here, okay, or you see a low here or a low here or whatever, and you want to go short, you know, you may be able to catch some pips that way. But for me, that's it's all about it's too much about timing and too much about being having to be exactly precisely correct in order to make money. So would I go short here? No. Would I go long here? No. What I'm looking for is for a pullback and then possibly a pullback and then a recovery of that pullback and then back in the direction of the trend. Okay, if that makes sense. Okay, so let's go. George, what about the stochastics indicator? I'm going to get to that in a second. That that is a part of the way I trade, and it's right here under oscillators. Okay. Oh, what about the? Oh, I'm sorry. What about the stochastics indicator here? Okay. Yeah, that's a good question. So, what is the stochastics indicator? I'll show you that in a second. Okay. This is one of the ways that I trade, but I'll show you this in a second. Okay, so let's move forward now very quickly just to go over, some of you may have seen this before, but I'd like to really drill this in because this is very important, okay? Whether you are a trend trader or a counter trend trader, this is very important. What is confluence? Confluence is simply an agreement amongst different time frames, amongst different technical tools, support and resistance, chart patterns, etc. All it is confirmation, okay? So, what am I looking for? Let me take a look here. Okay, let me show you something here real quick just to show you, just to illustrate the confluence here. Okay, let's go. This is the dollar Canada. Okay, U.S. dollar against Canadian dollar. I'm going to show you some indices and gold and oil and all that in a second. But for now, let's take a look at dollar Canada and let's show this confluence in action. Okay, and this just happened. This just happened in mid-May. Okay, and I don't usually trade dollar Canada, but this is a perfect example. Now, if you take a look at this, we have this uptrend support line. Now, this is a pretty valid uptrend support line here, okay? Now, coupled with this uptrend support line is this 200-day moving average. So generally speaking, the two moving averages that I use are the 200-day and the 50-day moving averages, sometimes the 100-day the 100-period moving average. So 200, 150 period moving averages. This happens to be a daily chart, so this is the 200, 150-day moving averages. On a 5-minute chart, it's going to be the 200, 150 5-minute period moving, moving averages. But anyway, that's besides the point. Here we have an uptrend support line, okay, providing support. We have a support level here. We see two tests around the 1925, 1930, or whatever, around that area, 1930, 1935 area, okay? We also have this 200-day moving average. So here we have several different confluence factors, okay? Also, we have a move up on the stochastics, a move up from oversold. So we have basically 4 different confluence factors talking about how this level could be support. Now, if we only had one of these factors telling us this, would it be as strong? And my argument is no, absolutely not. So the fact that we have 4 different factors, four different technical factors giving us support on the dollar Canada right here, does it mean that the U.S. The dollar Canada will not drop down below this line? No, absolutely not. But it gives a better rationale. If you're going to go long on dollar Canada, it gives a better rationale that this is around the point to get long at. Okay, at which to get long. Now, how do you get into this position? Do you get in right at the 1925 point? Well, I would say that's very difficult to know if that's the low that we're looking at. So, first of all, I like to look for the support resistance, and then I like to look for something like this, okay, which is a breakout above this counter trend line. Okay, and I'll show you this on the pound dollar in a second, but basically it's this, okay? So we have a counter trend resistance line, we have a breakout above there, okay? And that is, what is that showing me? That's showing me that I have strong support here. First of all, I have an uptrend, Okay, so we're still in an uptrend. Despite this drop to the downside, we're still in an overall uptrend. Now, if I'm looking to trade the daily chart, we have strong support right here, very strong support given by, as I mentioned, the four different factors, the 200-day, the trend line, and this 1925, 1930 area. 119.25, 119.30 area right here. Okay, so that provides support. Now, and I also have this stochastics down here. Now, am I smart enough to get in long here? No, I wouldn't say. If I got in long at the very bottom right here, I wouldn't say that I'm that smart. I would say that I'm that lucky. Okay, despite having all of this support here. Okay, I'm looking for further evidence that this is going to rise. And therefore, what am I looking for? I'm looking for a trend line break. I'm looking for a resistance break to show me that short-term momentum is agreeing with this support theory here, with this trend, and with everything else. So I'm looking to go long there. Okay. Hopefully that made some sense. So that is confluence. So what we just saw now with the dollar Canada was that we were looking for a confirmation confluence, and we had it right there at the 119.25 area or so. Okay, and then we're looking for a trick. After we see that confluence, we're looking for a trigger to get into the trade. And this is, and this slide is just showing you what are the different types of confluence you could have. For example, we have the moving averages. For example, we have support resistance levels. We have the trend lines. We have the oscillators. We could have a Fibonacci level here, okay? We could have lots of different things here. Let's see if there's a Fibonacci. Let me just draw a quick Fibonacci level here. Oh, what do you know? I mean, it's pretty good, okay? I mean, as you can see, I just drew it here. I didn't know this was gonna be like this, but this is not exactly correct. But here, we got some support on the 38% Fibonacci level, okay? I drew from this low. Oops, let me do this real quick. Okay, I drew from this low down here. Okay, so whenever you draw Fibonacci's from low to high, left to right, or from high to low, also left to right. So here we have we drew from the low to the high here, and then what do you know? But we also have a Fibonacci level, a 38% Fibonacci level, which is a key one. There's also 61.8%, also 50%. But for me, these two are the most important. These three, 38%, 50%, and 61.8%. Here, around approximately, we got the 38%. If we see a bounce from there, that could be a signal. Okay, that could be a signal to go long. And then if we see this breakout above this counter trend resistance line, then that works for me. That works for me as a potential trade opportunity to go long within the trend after support, after this big confluence of support. So basically, that's what it is. So we're looking at all these types of things. We're looking at the different time frames. We're looking at the different technical tools, including moving averages and support resistance, trend lines, chart patterns, candlestick patterns, and indicators, and all of that to inform our trades. Okay. Okay. Question here. Alex, I traded the deep pullback strategy, and I have a question. If I look for a pullback in 15-minute, I always look the 1 hour chart and the 4 hour chart, but I don't have trend in 4 hour chart. I enter in this trade. Thanks. Okay. Now, Alex, great question there, and I remember I think you asked this question on Monday, and sorry I didn't answer it then, but yeah, let me just quickly answer. I have a strategy called the deep pullback strategy, and basically what we're looking for is a pullback and then a resumption of the trend. And you're saying that you see a pullback in the 15-minute. I always look at the 1 hour chart and the 4 hour chart, but if I don't have a trend, well, okay. So basically, what we're looking for is basically what I'm talking about right here, which is you need to see the trend first on the longer term chart. Okay, so if you are using multiple time frames, then you want to be able to first pinpoint a trend. If you're only using the 15-minute chart, okay, if you're only using the 15-minute chart for a pullback strategy, then that's fine. It's a short-term chart. You're looking for short-term gains. Then you could look for a pullback regardless of the trend on the longer-term time frame. Okay, so for example, on the dollar Canada, I was just looking at the daily chart, and I'm not really looking at the weekly chart or the monthly chart. I'm trading off the daily chart. But if you are using another one of my strategies called the multiple time frame strategy, then you're looking at 3 different time frames, and for that you need to see that the longest term time frame has a trend. Okay. Hopefully that I know this is a little confusing, but hopefully I answer that a little bit. But basically, Alex, what we're talking about here is the trend pullback breakout approach. And I know, again, a lot of you have seen this before, but basically what this is that we're looking for a trend, we're looking for a pullback, and then we're looking for some type of a breakout. Now, if we take a look at here, at the dollar Canada chart, this epitomizes it pretty well. We have a trend, and this trend is outlined by this trend line, by this 200-day moving average, etc. We see a pullback, a pretty big pullback at that. Usually this is a rather big pullback, but we have a pullback nonetheless down to key support. We have confluence of support, as I just mentioned to you. Okay, so we have this confluence of support down here. We see this pullback to the support line, and then we see a breakout. So it's the trend, it's the pullback, it's the breakout. And what is this breakout? It's a breakout above this counter trend resistance line. And that's showing me that short-term momentum is breaking out in the direction of the original trend, in the direction of my intended trade, and therefore I'm going to take this trade. Okay, or this is a good opportunity to possibly take this trade. Okay, so and then we have where do we have our stop loss? Okay, so just like okay, let me just go back to the slides here. Just like with everything else that I talk about, when you're trading from a technical perspective, your stop loss will be where the market would be telling you that you're wrong. And in this case, after a pullback and then a breakout back in the direction of the trend, you're in the trade now. Okay, where do you put your stop loss? You put it where the market is telling you you would be wrong. Okay, which is down here right around the red level, a little bit higher than that, I would say, just under the pullback. Okay, so on the dollar Canada chart, if you were trading this daily chart, okay, this could just as easily be, any other type of chart. This could be a 5-minute chart or an hour chart or a 4-hour chart or a weekly chart or what have you. But whatever chart you're trading, if you see this, okay, if you get in, let's say, on this breakout to the upside, okay, then where would you put your stop loss? Well, simply, I would put it right under the low of the pullback, okay? Because that's telling me that if price subsequently comes back down and takes me out right there, okay, that's telling me that that pullback was not done yet, or this is not real support. This is not real support. We're seeing further moves to the downside, or this could be a reversal. Okay, whatever it is, I'm out of the trade because I had an idea, I had an opportunity, I had confluence, I had the trend, I had the pullback, I had the breakout, I had all of this, and I got into the trade. But I could still be wrong. Of course, you could still be wrong. So if you're wrong, then you have your stop loss to take care of you, and that's right where the market would be telling you you're wrong, which is if it broke down below this support level. Okay, so hopefully that makes sense. Okay, so you have the breakout, you have the stop loss there, and then you have your risk. Your defined risk is right here, and then you could define your reward accordingly, according to a reward to risk ratio, if you prefer to do that. Okay, so that's TPB trend pullback breakout. Here, same thing. I got the trend. This trend is depicted by the trend line, by the moving average. I got a pullback to the line, to the trend line. I've got a counter trend resistance line. I got a breakout, and that's my entry level. And then I've got my stop loss underneath. I got my defined risk, and then I could define my reward accordingly. Okay. Now the trend. So again, I'm talking about the different tools that I use. So we're talking about trend, support and resistance, moving averages, etc. Okay. The trend is simply the momentum of the market. Now, if you take a look here, okay, so if you take a look here, but let's just go back to this dollar Canada chart, because I like it. It looks pretty good. Now, if you take a look at this dollar Canada chart, you see that if you had gone this high right here is key resistance, right? Because it's right around the 128 level. We saw it tested here, and then we saw it retested here. So this is very strong resistance, okay? So if you're a counter trend trader, would you go short here? You might, okay, you might, and if you did, you would have made money. Now, would I do this? Probably not, because there's so many opportunities to trade in the market. Why, why take a trade that can seem risky to you? Okay, that can seem not as strong a trade as you could get somewhere else. So yeah, I mean, there is strong resistance here. That's good rationale for a short trade. It is very high. Okay, if we talk about an exhaustion trade, we could go short there, absolutely, if you're a counter trend trader. But and it happened to turn out well. But for me, no, I'm not going to take this trade. I would never take a trade like this. I would neither go long nor short here. Okay, again, I'm looking for trends. I'm looking for pullbacks. I'm looking for breakouts. But that being said, resistance and support are very valid. And if you're looking for places to go long or short, support and resistance are where they should it should be done. Okay, with a filter, and this filter being, of course, I'm looking for momentum also to go in my direction. Okay, so we're looking for trends. The trend is simply the momentum of the market. Trends never last forever, okay? But for sometimes prolonged periods of time, we see trends, and that's where I find or I look for my opportunities, okay? People say that, oh, there's no trend right now. Well, there's always a trend, okay? I'm looking at a ton of different things. I'm looking at all the currency pairs, the major currency pairs, okay? I'm looking at some currency crosses. I'm looking at the indices. I'm looking at U.S. indices as well as European indices. I'm looking at gold. I'm looking at oil. Okay, so there's always a trend to be found, a trend to be had. Like right now when we talk about crude oil, okay, there's really no trend right now. There has been a big trend to the downside since last year, okay, but currently when we're talking from a shorter term basis, there is no trend. Okay, let me show you this chart real quick. There is no trend right now on oil. I'm just going to show you the WTI or the U.S. oil. Okay, so right now I've outlined it right here. There is no trend on oil. Okay, right now we have been in the consolidation since the beginning of May. Okay, so we saw this. Yeah, we're still. I mean, if you take a look at this downtrend line, yeah, I mean, we're still in a downtrend on an overall downtrend on oil. And then what we see here is, and if there's a break to the downside, I'm going to be taking advantage of that. But after the April, we saw a range trading play. So here, there really is no trend that could be taken advantage of unless you're trading within the range. That being said, though, where is the trend? Well, there are trends all over the place. You take a look at the pound dollar I just showed you. You look at the currency pairs. You look at different stocks, different indices. We are still in pretty strong trends on all of those. Okay. So just because there's not a trend on a particular market you may be looking at doesn't mean there's no trend to be found. So the trend, I'm always looking for the trend. Okay, moving averages. Moving averages help in many ways. And I'm going to show you one way right here. Let's take a look at the pound dollar. Okay, so as you know, as luck would have it, yes, price has moved down, and I just told you not to go short on pound dollar. So, that's bad. It's pretty bad advice. But of course, I wasn't giving you advice. But I would say that I would not go long. I would not go short here. If you went short here, you probably made some money, you made a few pips, and then it may continue to go down further. But from a prudent trading perspective, I would not go short. And again, neither would I go long. Okay, so if we take a look at this moving averages, so we take a look at moving averages. Again, I use the 200-day and 50-day pretty often, and for example, the 50-day tends to move with the trend very well. We take a look at this euro-dollar daily chart. This is the 50-day moving average. It worked as resistance during this downtrend very, very well. Okay, and then we got into a period of consolidation and choppiness, okay? But during trends, if you're looking at strong trends, you're looking at the 50-day moving average working very well as support or resistance, okay? let's take a look here, not on here on Aussie dollar, same type of thing here, 50-day moving average, okay? Same type of thing here. And it continues to work as support and resistance. Here we have the 50-day moving average working as resistance within this this consolidation here on Aussie dollar, okay? And then here, of course, we have the 200-day moving average. But let me show you the okay, pound dollar real quick. So I'm using the moving averages as slope, trend slope indicators, as well as support and resistance. So for example, if I have an uptrend here, okay, I'm looking for a pullback to the 50-day moving average, okay? Once that pullback occurs, and we have to be in a trend first, and here we're in an obvious uptrend, okay? So we have this pullback occurs, it pulls back to the 50-day moving average. And then I'm looking at the stochastics, and I'm looking for stochastics emergence from oversold, and then I'm looking for this trigger to go long, okay? This didn't turn out to be such a great trade. It did a lot of consolidation, but eventually the trend was up, okay? And here as well, okay, so I'm looking for the same type of thing here. I'm looking for a pullback to the line here as well. Okay, but here the stochastics did not move down all the way down to oversold. So here I'm looking for an oversold, a pop down to oversold, and then across to the upside. And this is of course within an uptrend on a pullback to the 50-day moving average. And then I have this counter trend resistance line acting as my trigger to get into the trade. Okay, the potential trade. Okay, so moving averages, that's how I often use moving averages as trend indicators as well as support and resistance during trends. Okay, support and resistance, I think you all know what it is. Support is a floor, resistance is a ceiling, and again, as I just mentioned before, these are among the best places to look for possible turning points and look for where pullbacks tend to end. Okay. So as I mentioned here, let's say this pulled back not only to the 50-day moving average, but also to the 155. This is a larger support resistance level, 155 level. And we also get this move to the upside here. Now, if we take a look at the dollar Canada chart once again, here we have we have strong support right down here at the 119.25 level or so. Okay, this area right here, and then is this the end of the pullback? It could very well be. And how is it confirmed? By a breakout here. We're looking for a break to the upside to get into our trade. Okay, support and resistance and support and resistance, just as like I showed you here. If you take a look at right here on the resistance side over here on the right, we could see that there is a trading range there. And that trading range is very similar to what we're seeing on crude oil. Okay, so many people will trade within those lines, which is great, which is fine. Okay, but in terms of if there's a break of that trading range, I'm looking for a break back in the direction of the trend, which happens to be to the downside. Okay, so that's support and resistance. And again, within any trend, I'm looking for support and resistance to help dictate the potential entry zones. So if we go back here to this TPB, trend pullback breakout, you see this uptrend, okay? You see the pullback. Now, where is this pulling back to? It's pulling back to support. And how do I know this is support? Well, support is not just horizontal lines, okay? This could be, you could call this support because of this high up here, okay? So this high up here is around support, okay? But more important than that is that it's pulling back to this trend line, which is support. So when people talk about support and resistance, often they talk about just price levels, like the 155 level, okay, is a support resistance level on pound dollar. But for the most part, trend lines can also be used as support and resistance. So here we have a pullback to the resistance level, okay, and then here we have pullback to the support level, and then here we have a counter trend resistance line, and that is, we're looking for a breakout above that resistance, okay? So when we talk about support and resistance, we're looking for that to help dictate where where a turn or a change in the pullback might occur and where we could get into a trading opportunity. Fibonacci ratios, very much the same thing. What I just showed you on the dollar Canada, and I don't know why I keep coming to this, but it's just such a nice chart. So the dollar Canada, we see a pullback, and then this, I didn't know this before, but this was around the 38% Fibonacci retracement, so that adds to the confluence that I just talked about, and a place where price may bounce. If it doesn't, I'm not in a trade. If it does bounce even a little bit, I'm in the trade. Okay, I'm in a long trade. If it bounces and then it comes back down and takes me out, then I'm out of the trade with a stop loss. Okay, so whatever happens with this, I have a plan. Okay, so my plan is that if it reaches support, I'm going to see if this support holds. Okay, now if it does hold, I'm going to have a trigger line right here. If this trigger line is broken to the upside, I got my trigger as an entry into the trade. Okay, if it keeps going up, I'm going to manage the trade possibly by moving my stop loss up to break even. Okay, and then trailing my stop loss from there. Okay, if it goes up and it comes all the way back down, then I have my stop loss to take care of me, whether it's the original stop loss or the stop loss that I moved to the upside. Okay, so hopefully that makes sense. For every single market occurrence, I will have a plan. George, how do you know when to get out of the trade? Well, like I just, get out of the trade with a profit, you mean? Okay, so I think that's what you mean. If you mean, at a loss, to stop your loss, then you have your stop losses. But also, if you're talking about getting out at a profit, you also have your stop losses. So what I just told you was, you can move your stop loss up to lock in your gains. Okay, another way to do that is to have a profit target. Now, a profit target I will often use, but what I like to do is I like to move my stop loss in the direction of the trade so I can lock in my profits. But how do I choose my profit target if I have one? And sometimes, oftentimes I will not have a profit target, but how do I choose it? Well, you could choose it according to support resistance levels. For example, we have one right here. Okay, we have one right here as the target, or you could use a reward to risk ratio. So, for example, that's a really good question, George, by the way. So if I get in long here, okay, I got my stop loss right under here. So that's a pretty sizable, especially on a daily chart. Okay, so I wouldn't really be trading the daily chart, but if I was trading the daily chart, it would be a pretty sizable stop loss. Okay, if I got in there. Now that being said, how do I choose my profit target according to reward to risk ratio? Well, usually I'll have anywhere from a 1.5 to a 3 times, reward. Reward to risk ratio. Okay, so which means that my reward will be anywhere from 1.5 to 3 times my risk. Okay, usually if I'm trading from a trend trading perspective. If I'm trading in a range trade, okay, usually it'd be about 1 to 1. But if I'm trading on from a trend perspective, usually it's going to be 1.5 to 3 times. My reward will be 1.5 to 3 times my defined risk. Okay. And that's one way you could do it. But you could also use, further resistance or support levels, and you could also move your stop loss. Okay, which I often do because I like to lock in my gains and see how much I could get out of a trade as it's going. Okay. Okay, so Fibonacci ratios are another, it's another form of support and resistance. That's basically all it is. Another form of support and resistance is another tool we use. Candlestick patterns, also same type of thing. I talked about this a lot on my one of my last webinars recently, and you could go take a look at the recording there. But that also is part of the confluence that helps me decide whether to get into a trend trade or not. And it also can help me decide whether to get into a counter trend trade. How is that? Because candlestick patterns, especially this hammer and shooting star right here, are very good at dictating potential turns in the market. And this occurs very often within ranges. So if we take a look, for example, this is an Aussie dollar chart. The only reason I'm going all the way back here on the Aussie dollar chart is because you know, I don't want to be searching through stuff and wasting time here, but this is just a side note here. In terms of if you're a range trader, counter trend trader, you want to see beautiful candlesticks like this and beautiful candlesticks like this. Okay, 1, 2. Okay, those types of things are very, very good. Okay, so in terms of candlestick patterns, this is a shooting star. This is a hammer candle. Okay, and this is a daily chart, by the way. But so what does this mean? This means that if you're a counter trend or a range trader, this is helping your confluence. First of all, we have resistance here. Second of all, we have this huge shooting star pattern here, okay, which means it went all the way up, came all the way back down, it got rejected near resistance, it failed near resistance, and we're looking to the downside, and this is a very good trade, okay? Now, if you want to get into that trade, what you could do is you could draw a line here if you wanted, okay, and you could play that breakdown there. By the same token, over here, you could draw this type of a line, okay? Once you see this candle, you could draw a line and then see, okay, where does this breakout occur? After the breakout occurs, there's a lot of whipsaw, but eventually, we're towards the bottom of the trend. Okay, we're towards the bottom of the trend. We have this beautiful hammer candle right here. Okay, we got this stochastics helping us with this trade. Okay, so we got a confluence of factors. We got strong support right around here. Okay, we got the oscillator. We've got the great hammer candle right here dictating this trade. Okay, so candlestick patterns help whether you are trading with the trend or you are trading against the trend. Okay, now where do these hammers and shooting stars, where do they help when you're trading with the trend? Well, simply after pullbacks, oftentimes, for example, if there's an uptrend, there's a pullback, and then oftentimes at the bottom of that pullback, we'll see a hammer candle, much like this one right here. That's saying that price action is getting rejected around that area, and therefore I'm looking for a potential trade to the upside. Okay, so again, there's an uptrend, there's a pullback, there's a hammer candle. I'm looking for a breakout to the upside to dictate my trigger to get into that trade. Okay. Okay, and we're not going to really talk about these that much. Okay, so oscillators. Now, oscillators, just as I showed you, how do I use these oscillators? Well, when I use it within the confluence. Okay, so let's take a look at this Aussie dollar range play again. Okay, so if you take a look at this, what are you looking at here? I'm looking at the stochastics, as you can see below. This is a 1433 stochastics. These are the settings there. But basically what I'm looking at is for that to help confirm my trade. Again, it's all about confirmation. Okay, Sam, the question is, the great question here as well, how do you determine whether to go long or short from a doji candlestick? Okay, great question. Now, doji candlesticks, which is basically, this right here, okay? This is a doji candlestick. Now, where it opens and closes at or around the same place when it closes at or around the same place where it opened. Now, how do you know where to go on that? Well, you really don't. That's the answer is you really don't. If it happens, if a doji candlestick happens in the middle of nowhere, like it does right here, for example, or right here, or whatever, okay? So it happens all over the place. If it happens in the middle of space, in the middle of nowhere, you don't know, okay? So you have no idea. That's where the confluence again comes in, okay? So if you find a doji candlestick right around resistance, okay, and you have your other confluence factors showing you that this should be a short trade, then and only then is that doji confirming a short trade. By the same token, if you have a doji right near a support level, we don't have one here, but if you have it right near a support level, okay, and it's within a range, and you have other factors, including, let's say, your stochastics, and other things showing you that this could be a long trade, then and only then is that doji confirming a turn near the bottom of the range, okay? So very important there, very good question there. What does a doji tell you? In and of itself, it tells you nothing. What it does tell you is that there's indecision in the market, okay? But you don't know what's going on there. What a doji will tell you is, and where it is valuable, is where it occurs in a specific place. For example, near support, for example, near resistance, and where other confluence factors are helping you with that trade. Okay, so this thing right here, this shooting star right here, in and of itself, doesn't mean a whole lot. Okay, let's see where we could find a bunch of others probably all over the place. Okay, so let me see. Right here. Okay, let's say right here. There's sort of a, okay, right here. There's sort of a shooting star. It happens sort of in the middle of nowhere. Okay, so and this 105 level came from later. So this sort of happened in the middle of nowhere. Okay, so does that tell you much? Not really. Okay, but where it happens near resistance and it's confirming other things that are going on, then that's where it becomes valuable. Okay, so that's why I'm not a candlestick trader. I am not a moving average trader. I am not a trend line trader. I'm not a stochastics trader. Rather, I'm a holistic trader. I take all of these tools and I put it all together. Okay, and that gives me the highest probability of making a high probability profitable trade. The highest probability. Again, I'm saying highest probability. I'm not saying a sure trade, because never do you have a sure trade. That's why you have your risk management take care of you. Okay, great question there. Okay, so yeah, I'm not going to go through all these. Okay, so basically, I went through most of it, and oh, okay, good. So this went up. The pound dollar went back up a little, so I don't have to lose so much face there. Okay, so here, if you take a look here, it's very, very simple. If you're trading from, this is showing, obviously showing your trend. Okay, this is showing, so the pound dollar is very good in terms of showing trends and entries into trends, and as well as exits. Let's see. So we are seeing trends here, and a simple methodology is simply within trends. Okay, I showed you the counter trend and the range trading, but within trends, a simple methodology is what I've been talking about all along. You're looking for a trend, you're looking for a pullback within that trend, you're looking for a breakout. Okay, so case in point here, we have a pretty well-defined trend here. Okay, we have the 50-hour moving average here. This is an hourly chart, and then we have a pullback. Okay, it pulls back to the 50 period moving average. Okay, and then we have and you look for other confluence factors as well, and then you have this emergence down on the stochastics. Okay, and then you also have this breakdown below your counter trend resistance line. Okay, so this is showing you a break back in the direction of the trend. Okay, and that's a potential short trade. Okay, same thing over here. Okay, so here, and same thing over here as well. Okay, and then here, when we're in an uptrend, as we see now, same type of thing here. We're looking for a trend, which we have. We're looking for a pullback, which we have in many different places. We're looking for breakout, which we have in many different places. Okay. Okay, so that's pretty much what I have for now. If you have any questions about what I brought up today, and I'm sorry I didn't have enough time, I sort of covered two different topics at once. Next week, or I'm sorry, 2 weeks from now, we're going to be talking about breakout trading. And if you have any questions regarding anything you saw today, please email me at james.chen@cityindex.com and take a look at our analysis on cityindex.co.uk. Again, any questions, please email me. I would like to thank all of you for your time today, and see you in 2 weeks. Thank you very much.